Hey traders, Scott Barkley with ProAct Traders. Some of my traders in my live class were struggling with price action, so I asked ChatGPT to give me what are the main struggles traders have with learning it. Brought back quite a few information, so enough that I thought maybe I ought to do a whole video presentation on this. So this is going to be a series of short videos to help you through the process of learning what price action is, how to use it, how to solve the problem in your own case, and how to become a better trader. So let's get right into the video. All right, this is continuing on with our struggles with learning price action series. This is lesson 7, Reading Candlestick Patterns. So I asked ChatGPT and it says familiarity with various candlestick formations is essential. Traders often find it challenging to interpret these patterns correctly and to understand their implications for future price movement. All right. So this is probably the easiest struggle to rectify. All right. You only need to concentrate on a few patterns: doji stars, close and reverse, exhaustion wicks, and engulfing candles. Practice what they do so you know what they're telling you. All right, so we're going to tackle each one of them. And don't forget, mastering each piece of the puzzle gets you to experience. You see, I can give you education, but I can't give you experience. Only you can do that. So doji stars always signify indecision. They are particularly significant at the end of a run. The highest percentage of these are signal reversal, right? So you can see here, you see them at the end of the run. You know that was going down because you can see the moving average is just, slightly moving to the downside. Had 3 of them right there, okay? And then we have one at the top. It signals the reversal, all right? So what has to happen? Well, they're going to reverse, but reversing takes a long time, all right? And you also see this one. Can we break the top? See, it's indecision. Are we going to break the top? I don't know. Let's go find some buyers. Oh, there they are. We got them. Okay, there you're good. See? All right, close and reverse. Always signify reversal, even if temporary. Close means just that. They closed the former position and instantly entered the exact same lots in the reverse direction. Easiest to see, hardest to practice. So, you see how they reversed it even just for a pullback. Look at every one of those, the direction turned on the close and reverse. Now, it may have been temporary in a pullback like over here, or a pullback over here, or a pullback over here. So, you need to know where your tops and bottoms are, so when you get one up here, you realize, oh, you know what that is? That is probably a reversal because my top is up here, all right? And you can see what they did with that. There it is right there, okay? So, how do big boys capture their profit? They do a close and reverse. So close and reverses are created because institutional traders are taking positions in the new direction, close and reverse. Remember, the only people who can print candles are big boys. Close means they took profit. Reverse means the same amount of lots are now invested in the new direction, whether it's a pullback, a break hook and go, or reversal. The higher the time frame on the chart, the more reliable they are for trade opportunities. We like the 60-minute for power moves early enough, but not too late. And it is with the intraday bank traders who enter and exit on the 60-minute chart. This is what their book trader looks like. You see, they can close the position if and then they're out of the market. But if they reverse the position, they closed the position and took the profit and reversed in the other direction. This is why they're called market makers, not market followers. We are market followers. They are market makers. So they reverse direction when it's in their best interest. So close and reverses, any second candle that breaks the former high or low by 1 pip, depending on direction, is a clear sign of follow-through and a trading opportunity if it's in harmony with the structure. In other words, if I'm going up, I don't want to take a close and reverse to the downside. I want to take the close and reverse to the upside. See? All right, stops are just 5 to 7 pips above or below the close and reverse, depending on direction. So typically they have very, very low risk and extremely high reward. When you see a close and reverse on a 60-minute chart or higher, believe them. So the candle starts off like this. We're going down, all right? Then we have a close and reverse right here, okay? So we now know the new direction is to the upside. Why? Because they closed the short and entered the long, all right? So 1 pip above this body top, or body bottom if you're shorting, is the entry, all right? And the stop is just below the wicks of the close and reverse, all right? Let's take a look at exhaustion wicks. These are telling you the reversal is taking place inside the candle. It is exhausted in the current direction or out of participants, and so they got to go find the participants or they're reversing. There are only two things. They're either looking for more participants or they're reversing. Now, remember, it may only be a pullback, and MACD is your friend here. We've already talked about that in a couple of earlier tutorials. So exhaustion candles or wicks, the exhaustion candle signifies a turning point. You find them on the 60-minute chart for best results, all right? You know, they're sometimes tradable on a 10-minute, but 60-minute is really, really rock solid, okay? So what's happening here? The candle is going up, and then massive selling takes place. Well, because it closed above its opening, it's going to be a bull candle. But that's not the information that that candle is telling you. The candle is saying we're reversing direction. Think of a tadpole. The only way it can swim is in the direction that its tail is going. All right. So think of this wick as a tail pushing the candles to the downside. All right. And lastly, we got the engulfing candle. The engulfing candle is a large one that follows a previous candle of the opposite direction. The engulfing candle is much larger than the first, all right? So you can see how prominent they are in the chart, okay? And you can see that every time the engulfing candle came in play, that was the direction, 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 all right? See that? And you say, well, why did they pull up here? Because they put the money in 3 times. They got to come out of here 3 times. They're only out twice up here. Another lesson on that. So here's a hint. It takes 300 images of each pattern for your brain to build reticular cognition. Reticular means you see it. Cognition means your left brain instantly understands it. How do I get it to understand it? That's why you have to do 300 images. And here's the note. You must take 24 hours off after doing one exercise, okay? So you decide to do 300 close and reverses today, all right? You do that, all right? Tomorrow, you don't do any close and reverses. You don't do any patterns. The next day, okay, now I can tackle exhaustion wicks. Same thing, all right? Why do we do it that way? Because that's the way your brain works. If you don't work with your brain, you're working against your brain. So once we practice these enough, we can see them in our sleep. They are the main form of communication in the charts. Wait a second. It's the main form of communication? Yeah. And I don't know anything about it. Yeah. I wonder why I'm losing. Yeah. These patterns telegraph the agenda to knowledgeable traders. All right. So later you can learn head and shoulders, inverse head and shoulders, rising and falling wedges. These are the actual reversal patterns, and only an advanced trader should trade the actual reversal. The real trader knows exactly what the chart is saying. The dumb money knows only what their indicator is saying to them. So don't be that person. Throw the indicators away and persevere through the learning curve of price action. Now you can earn while you learn and be well on your way to an accomplished trader who can trade with the big boys. It looks easy, but it's not. Each piece I showed you should be practiced separately, not all pieces at once, 300 times. Then practice in the past, looking only for the actual information that will help you make the decision. We call this forensics. Big boys do what they always do, so the past proves the future. Throw away every indicator you have but a MACD. So key number 7 is to practice just these few patterns 300 times. Know what they're telling you and prove that to yourself during the exercise. We'd love to have you watch us do this in real time in a live room. Just go to proacttraders.com and sign up for a test drive, and you'll see traders making hundreds, if not more, pips doing what this video is about. It's free, by the way, and don't forget to like us, subscribe, and share. Remember, if you subscribe, you'll be notified when I put a new video up. Hope that helps you, everybody.